If you are trying to buy a home right now, especially as a first-time home buyer, you've probably seen the headlines or the TikTok videos screaming, get $15,000 in free government grants to buy a house, or how to buy a home with zero money down using down payment assistance. As a real estate agent here in Minnesota, I'm going to tell you something that a lot of lenders and aggressive agents don't want you to fully focus on. Down payment assistance programs can completely suck. Now wait, before you turn this video off, let me clarify. I don't mean they suck because the intent is bad. Providing financial aid to help people achieve homeownership is fantastic. They suck because of the absolute lack of transparency regarding how they actually work and the massive financial strings that are attached to your title the moment you close. Most buyers enter these programs thinking they're getting a gift. They leave closing with a second mortgage, a restricted interest rate, and a financial trap that triggers the moment they try to sell or refinance down the road. In this video, we're going to look past the marketing fluff, and we're going to break down the exact mechanics of these programs, look directly at the guidelines for Minnesota housing programs like StartUp and StepUp, and look at the real math, so you can decide if these programs are actually a lifeline or a liability. To understand why these programs feel like a trap later on, we have to look at what's happening behind the curtain right now. When you buy a home, you typically have your first mortgage. That's the big loan, covering 95% to 97% of the home's value. Down payment assistance exists to cover the remaining 3% to 5% down payment plus your closing costs. But here's reality check number one. The state housing finance agencies are not charities. They are state chartered authorities that issue housing bonds. That money has to be accounted for, tracked, and ultimately paid back. Generally speaking, down payment assistance, or DPA, comes in three primary flavors across the United States. The first, true grants. This is actual free money. It's incredibly rare, highly restricted by income, and usually runs out of funding within the first few weeks of the fiscal year. Second are forgivable soft seconds. These are loans that slowly disappear. For example, if you stay in the home for 5 or 10 years, a percentage of the loan is forgiven every year until it hits zero. The third is repayable second mortgages. This is what the vast majority of buyers actually end up with. You are taking out a second loan directly on top of your first mortgage to cover the down payment. And this is where the breakdown of communication happens. Buyers hear the word assistance, and their brain translates it to gift. The reality, you're just stacking debt on top of debt. So let's talk about the specific strings attached, because this is where the long-term financial impact hides. String number one is the interest rate premium. When you utilize the state down payment assistance program, you don't get to shop around for the lowest, most competitive market interest rate. The state housing authority sets that interest rate for their specific program statewide. And almost universally, that rate is anywhere from 0.25% to a full percentage point higher than standard non-assisted market rates. Think about that. To save $10,000 upfront today, you are locking yourself into a higher interest rate on a much larger loan amount for the next 30 years. You are effectively financing your down payment at a premium rate. String number two is the repayment velocity. If your assistance isn't a grant, you have to pay it back. If it's an amortizing second loan, that means your monthly housing expense goes up significantly. Not only are you paying your primary mortgage, your property taxes, and your homeowner's insurance, but you now have a second monthly bill going directly toward paying back that down payment cash. This creates a massive paradox. The program designed to make housing affordable upfront actually makes your monthly lifestyle significantly tighter. But string number three is the biggest culprit. This is the one that causes frantic, angry phone calls to the real estate agent years after closing, the refinance and sell trap. Many assistance loans are what we call deferred. You don't make monthly payments, and it sits at 0% interest. It sounds like the ultimate deal, but it sits on your home's title as a lien. The very second you try to sell your home, move out, and turn it into a rental or refinance your main mortgage because market interest rates have dropped, that deferred loan becomes due in full instantly. To make this completely real, let's look at how this plays out locally right here in Minnesota. The Minnesota Housing Finance Agency, or MHFA, runs two primary first-time buyer tracks: StartUp for true first-time buyers and StepUp for repeat buyers or those who exceed the standard income caps. When you apply for down payment and closing cost assistance through MHFA, you can typically access up to $14,000 or $18,000 depending on the specific tier. But look closely at the framework they give you to choose from. There are three main options. The first one is a monthly payment loan. The maximum amount that you can take is up to $18,000, and that interest rate will be same as your first mortgage, and the repayment term is over 10 years. The catch? It adds a permanent second payment to your monthly budget. The second option is a deferred payment loan. The maximum amount that you can borrow on this is up to $14,000. The interest rate, which is great, is 0%. The repayment term, though, is due upon sale or transfer. And the catch with this one is this acts as a silent lien, strips away your equity when you go to sell or refinance. The third payment is a deferred payment loan plus program. This one you can borrow up to $18,000. The interest rate, still 0%. The repayment term on this one, though, is due upon sale or transfer, just like the last program. And the catch with this is it is highly restrictive targeting criteria, and it requires repayment in full at exit. Let's dissect the real-world frustration with the deferred payment loan. Imagine, you buy a beautiful townhouse in Plymouth or Woodbury. 3 years later, market interest rates drop significantly. You call up a lender and you say, hey, I want to refinance to drop my payment by $300 a month. The lender pulls your title and says, great, but we have to pay off that $14,000 MHFA silent second mortgage first. Unless you have $14,000 in cash sitting in the bank, or your home has skyrocketed in value so you can roll that $14,000 into the new loan, you cannot refinance. You are effectively locked out of saving money because of the assistance you took years ago. So let's look at two scenarios side by side, and we can look at the math so you can see the true cost of free money. So let's assume you're buying a $350,000 home here in the Twin Cities metro area. Scenario A, you use the MHFA StartUp program with the maximum $18,000 monthly payment loan. Because you used the down payment assistance program, your first mortgage interest rate is bumped up to 6.75%. Plus, you have that second mortgage payment spread over a 10-year term at the same 6.75% interest rate. Your combined principal and interest payment comes out to roughly $2,450 a month. Scenario B, just a standard 3% down loan. You've scraped together your own 3% down payment, which is $10,500 on a $350,000 home. And you secure standard market financing. Because you aren't tied to the state's program rate sheet, you lock in a clean market rate of 6.25%. Your monthly principal and interest payment, $2,090 a month. Look at the difference. By saving $10,500 out of pocket up front, you are paying $235 more every single month in scenario A. In just under 4 years, you've completely burned through the entire value of the assistance program in excess interest and duplicate loan payments, and you still owe money on that second mortgage. So, do down payment assistance programs completely suck for everyone? No. If you have stable income, solid job security, but absolutely zero cash in savings, and your rent keeps skyrocketing year after year, using a program like MHFA is a highly valid, realistic, and totally okay program to get your foot into the real estate market. It beats waiting 3 years to save up cash while house prices continue to climb out of reach. But if you do have the cash saved, or if you have access to a family gift, which not everyone does, don't use these programs just because a piece of marketing called it free money. You are almost always better off using your own funds if you can, in securing a lower market interest rate, keeping your monthly payment low, and keeping your property title completely clean of hidden strings. The most important tool you have when buying a home isn't financial aid, it's clarity. Work with an independent mortgage broker who will map out both options side by side, or utilize a lender that your agent knows personally. And by the way, find an agent who cares more about your long-term wealth than a quick close. If you're looking to buy or sell or invest right here in Minnesota, I would love to be that clear, honest resource for you. Drop your thoughts or questions in the comments below. Hit that subscribe button for more real estate transparency, or send me a direct email via the link in the description. Let's get you into a home with your eyes wide open. See you in the next video.